Hey there, Val Miller here with Neo Home Loans, and today we are going to go over different loan programs and the details of each one. So, credit scores, down payment amounts, the questions that a lot of people ask when they have an initial conversation with a mortgage advisor. So, we're going to start with a middle of the road, all reliable, conventional mortgage. So, conventional, the minimum credit score needed is a 620, but that doesn't mean that if you have a 620 credit score that you should go with a conventional mortgage. So sometimes you can get a lot better terms with an FHA. I'm giving very blanket advice here, but really it's up to your specific situation. So if you want to get answers that are specific to you, have a conversation with someone. I'm just trying to give very generic advice, but everything's ultimately going to be custom to your scenario. So anything 620 or above could potentially qualify for a conventional mortgage, and your debt to income ratio has to be below 50%. What that means is all of your debts, including your housing expense, has to be less than half of your gross income that you're bringing in. So your income before taxes are taken out. So when you're thinking about if you qualify for something or not, that's a general rule of thumb is take all of your debts that you have on a monthly basis. So that car loan, any credit card payments, and add that up with what your anticipated housing expense is going to be. And if that's less than 50% of your gross income, then you might be in line for that. And you might qualify for a conventional mortgage. Now, as a first-time buyer, you can put as little as 3% down with a conventional loan program. Now, every purchase after that, the minimum is going to be 5%. So they're a little more lenient with that first purchase when you don't have equity coming from your previous home. But anything below 20% down payment, you will have mortgage insurance. That's just going to be sometimes it's a small payment. It depends on your credit score and all the factors that go into it. But mortgage insurance will be on there until you reach 20% equity in that home. So as you make payments, as your home gains value and you have 20% equity, you can then get that mortgage insurance dropped off. So it's not there for the life of the loan, but anytime you put less than 20% down, with the exception of a VA loan, you will have mortgage insurance attached to it. So that is your conventional mortgage. Now, if you're a buyer that maybe your credit score is a little bit lower or you have more monthly debts where your debt to income ratio is a little higher than 50%, the FHA loan allows some more leniency with qualifying. Now, the downsides to an FHA loan, you're going to have mortgage insurance for the life of that loan unless you refinance into conventional. So even when you reach that 20% equity, you're still going to have that mortgage insurance attached. And you have what's also called an upfront mortgage insurance premium. So that's going to be 1.75% of the loan amount. That can just be rolled into your loan. It doesn't have to come as cash out of pocket, but it is just an extra layer of it's basically them saying, hey, this loan's a little bit riskier, so we need to protect ourselves. And that is the way that they're protecting themselves is getting that mortgage insurance premium up front. So again, it can allow you to get into a home if you wouldn't qualify for a conventional mortgage otherwise, but there are of course some downsides to it. There's pros and cons to all of them, but it's still a great option if you are one of those buyers that your credit score needs a little bit of work. Something to note as well is FHA typically comes with lower rates. So again, the lowest rate doesn't always make the most sense. Again, you have those downsides that we just talked about, but the benefit is you can get, it's kind of like a give and take. Like you have to pay a little bit more with that mortgage insurance monthly, but you get a little bit of a break from your interest rate. Now, my personal favorite loan program out there, it is the absolute best if you can qualify for it, is the VA loan. So this is a way to give back to those who fought for our country, and it's very deserving. And if you qualify for it, absolutely take advantage of it. A VA loan will allow you to put 0% down with no mortgage insurance attached to it. So even if you put 0% down, you will not have that mortgage insurance attached to your monthly payment. And VA loans also come with those lower interest rates as well. So it's really the best of both worlds all the way around. And again, if you are one of the people who fought for our country, number one, thank you for your service and definitely take advantage of the VA loan. There's some misconceptions around it. And of course, you do have those agents that unfortunately sometimes we need to have a conversation with them if they're not looking to accept any offers with a VA loan. We see that occasionally, but at the end of the day, we can have those conversations and we can go to bat for you because, again, it's something that you should be able to take advantage of and not look down upon in any way because you're choosing to put 0% down. The next loan we're going to talk about is a USDA loan. Now, there are some, let's say, boxes that need to be checked in order for you to qualify for a USDA mortgage, but these have to be in a rural area, and typically it's for moderate to lower income families. So if it's in a zoned area where that home is USDA approved, then you could potentially be eligible to get a USDA loan. This also requires a 0% down payment, but you will have that mortgage insurance again for the life of the loan. So there's always a downside, really, except for VA. Not much of a downside with that. But typically comes with a little bit lower rates. That mortgage insurance is going to be a little less than FHA. So it's a great program if you can qualify for it, but again, needs to be in the right location and you can't have an income that is above the limit that they set. So it has to be home specific. So have a conversation if your mortgage lender is saying that you could qualify from an income standpoint. You just need to relay that message to your real estate agent so that they're looking at homes that are USDA approved or in that zoning area. Last but not least, we will cover our jumbo loan or our non-conforming loan. Now, a conventional loan can only go up to a certain limit, and this limit changes every year depending on income numbers, inflation. This number will move on a yearly basis. So we wait until those new loan limits come out every year. And for 2025, that limit is $806,500. Meaning, if your loan amount is any more than that, it is considered a jumbo loan. And those come with stricter qualifying guidelines. So you typically need a great credit score, need to have that debt to income ratio in a good place. And most times you do also need 20% down. Some places you can find a little less from a down payment perspective, but your terms are going to be much worse. If at all possible, I would recommend put that extra money down to keep yourself within that conforming loan or the conventional mortgage because you will get better rates. They'll be a little bit more lenient from a qualifying perspective. Jumbo is just like the best of the best. So you're going to be held to a higher standard and your rates and terms are not going to be as favorable as that conventional mortgage. So if you are getting into the $1 million price range, again, have that conversation with your lender to see if you can stay, if you have enough assets to stay in the conforming loan limit space. But those are the meat and potatoes of mortgage loan programs. So again, if you didn't hear a product or a program that fits your needs, that does not mean that there's not one out there. There's a lot of unique loan programs specific to self-employed borrowers or even people that have no income right now. Of course, other boxes need to be checked, but there are very creative ways that we can get you approved for financing, but these are going to be the main ones that most borrowers fit into. If this video was helpful, do me a favor and like the video and send it to a friend. Subscribe to my channel so that you can see future videos moving forward. And as always, if you have a specific situation that you want feedback on or want to see what qualifying looks like for you, feel free to reach out.